3.1 to now $5 billion, and that revision downwards, in terms of the surplus size at least, is reflected right across the forward estimates.
Yeah, basically we've seen a halving of the surplus over the next 4 years. You can see the size of those write-downs. They are considerable. Previously they were talking about $45 billion worth of surpluses. Now it's $23 billion. A chunk of that difference, extra decisions to spend more. The rest very much down to where the economy is.
And basically what the government's allowing the budget to do is to take that softening, to absorb that softening, and in terms of spending and in terms of the other parameters, basically let that surplus reduce in size from about $45 billion across the forward estimates to half that, and basically letting that to be the automatic stabiliser.
Yeah, and so in terms of what is the government doing to help the economy, answer is there are policy decisions that have, other things equal, cut the surplus by about $8 billion, things like those bring forwards around infrastructure and the like, more money in aged care and for the drought. The other thing, as you note though, is as the economy weakens, the amount of tax that we're otherwise going to pay is coming off as well. For example, less personal tax, one of the more notable revisions.
So what's the key reason for this revision down in terms of revenue, Chris? Is it the GST take being softer than otherwise expected?
Yeah, that is the largest single dollar difference. You know, they have seen very large downward revisions to revenue across the 4 years. Biggest single bucket is the GST, and it's happening for two reasons. Consumers aren't getting the wage growth, and they're more cautious. That combination means they're being careful with their spending, which means less GST. But the other thing too, you're seeing in Treasury's revisions to the economy today, not just less spending by consumers, but less housing construction, fewer apartments, for example, getting built. That affects the GST take as well.
Are you comfortable with this approach, the fact that the surplus, because I mean the argument has been that the government should put the surplus to one side. It seems from their approach in the mid-year budget update that they're listening to that criticism to some extent, but holding on to that holy grail of a surplus, and still $5 billion. It's not wafer thin, but it's still, you know, a commitment that they will deliver, that they're politically, as we know, committed to.
Yeah, and if you think of the unusual thing that's been happening around the economy and the budget in the last 18 months or so, we had the economy weakening and yet the budget strengthening. And the key thing there was that unexpected degree of strength in things like iron ore prices, coal prices and the like. In this set of forecasts, they're starting to say, well, hang on, you know, we will now see an even faster fall off than we thought before. In commodities, things like iron ore, they're seeing that price come down $30 US a tonne between here and June. Other things equal, that means a chunk of money out of the economy and out of the budget.
Let's look at the next graph I've got here, the budget outlook, surplus across the 4 years. Receipts down, as you said, in large part. If you just take a step back there, Chris, for our viewers can see that on the screen there, receipts down 32.9, payments 19.7. Talk us through those numbers, particularly the receipts revision down.
Sure. So first one, they used to be looking for $45 billion worth of surpluses. That's basically halved down to 23. Some of that's extra spending, but the bulk of the change is what you're talking about here. Big write-downs to revenue, but partly offset by some pretty solid write-downs to spending. The big write-down in revenue, $33 billion across the 4 years, basically. The dominant driver, as you note, GST down. You've got less wages, you've got less housing construction, you've got conservative consumers. That means less GST. Less wages also, however, means less personal taxes getting paid by people. There's a lot of talk about fiscal drag, people getting pushed into higher tax brackets. But if you don't get much by way of wage growth, you don't get the fiscal drag.
Indeed, and that payments figure of 19.7, that includes the recent spending that we know, expedited spending on infrastructure, on aged care and on drought support as well.
It does. This specific one is just the changes in the economy. And lots of people will say, oh, you know, the government is cutting spending. what's happening is the economy looks different. You know, today's revisions, very much like revisions we've seen out of Treasury for a while, dominated by lower wage growth. But if you get lower wage growth, you get lower inflation. And that combination, that saves the government on, you know, pretty much every program is indexed to some combination of wages and prices. If wage and price growth is lower, you get savings on spending. Big bucket around interest rates, they've fallen a lot. Don't think Reserve Bank. It's actually the 10-year borrowing costs of the government come down a long way. So a lot of the savings on spending is lower interest rates, and almost half is the GST. Bad news, you know, 10 billion over 4 years. Bad news in receipts, bad news in spending. It washes through for the federal government. But the biggest losers out of today's update, absolutely clearly state governments. $10 billion less to play with over the next 4 years.
Let's bring up the GDP outlook. What are your thoughts on this? Is your thinking that the government's been cautious, conservative in terms of their suggestion that growth will be back up to 2.75% in the next financial year and then up to 3% in the out years?
Their forecast recovery in the economy is a bit braver than ours. If you look, you know, so there's a range of negatives. The drought is hurting, the consumer caution is hurting, bits of the world's slowdown are hurting. You can expect you know, things like the drought to eventually end and those things to have a useful impact. But that glide path back to economic recovery is faster than we at Deloitte Access Economics see. A key point of difference is consumers. You are seeing, you know, Treasury seeing a relatively rapid rebound in the pace at which consumers are spending. For that to actually happen, you need consumers to come out of their shells a bit and be a bit braver around their spending. So
in terms of that more greater optimism out to, as I said, 2.75%, then 3% in the out years, what's Treasury's rationale behind that? Is it that there gradually will be an improvement in consumer confidence with the property market rebounding?
Yes, that, but also the drought. You know, if you assume the drought ends, and they assume, you know, not this financial year, but further out in time, 2020, 21, the drought is no longer weighing on growth, and that is also helping to see something of a recovery. Those basic ingredients, you know, the drought eventually ends, consumers get less scared, and maybe some of the fears on the world front, you know, don't materialise, that calms down. Those are the three vital ingredients they're looking for economic recovery. I'd agree with the ingredients. How well the cake bakes and how fast you see that degree of recovery, we would argue the toss a bit on that.
Let's look at the unemployment numbers now, because it's interesting, this issue, because Shane Wright touched on it in that news conference as well. There's a discrepancy here between the Treasury expectations on unemployment and that of the RBA when it comes to when wages will finally tick up. Talk us through these forecasts and how there is that difference between the RBA and Treasury on that.
You can see the red arrows. Unemployment is now expected to be higher than Treasury used to think for the next couple of years. You can see, though, that they're eventually imagining, off the back of the things like, you know, drought doesn't last forever, consumers get their mojo back to some extent, that drives a gentle fall in the unemployment rate from 5.25 down to 5. Now that is a key difference. You know, at 5% unemployment, Treasury wants to wave a flag saying mission accomplished. 5% unemployment, not heaps lower than today, is enough to get wages moving again. But that's very quite a public difference with the Reserve Bank. Reserve Bank changed its mind at the start of this year, 2019, saying, hang on, it's getting harder to make wage growth move faster. We don't think, we the Reserve Bank, don't think that 5% is going to be enough.
Yeah, well, let's look at the wages index there, 2.3% growth. We know that it's been very sluggish. The Finance Minister, though, saying that it's the difference between that and inflation is greater than it was when Labor was in office, so quite defensive on that. But still, out in the out years, optimistic that it's going to get back up to 3%. Again, is that too optimistic in terms of that projection?
It is. You can see those red downward arrows go across all the years that we're seeing forecast in the budget. Every single year they see wage growth is lower, but it may not be low enough.
Basically a new normal in terms of wage growth.
Yeah, and that's the risk. We were talking a moment ago about how fast the economy recovers. I do think it'll recover, but that it'll be slower than Treasury is saying. Same deal around wages. We don't see, including in the financial year we're in, 2019-20, government seeing 2.5% growth in wages. We don't. All right? It's going to be tougher going. Yes, it will gradually get better, but not to this extent. And that, the new normal has changed. There are good things about that all over the world, not just in Australia. Growth these days shows up more than it used to in jobs, but less than it used to in wages. You heard the Treasurer in the press conference talking about the great success around jobs. The flip side in this global story is a lack of success around wage growth.
We spoke about that surplus being revised down in size because of the revenue being hit, but also let's look at the major spends, because this is also what's factored in to the revision downwards in terms of the size of the surplus, if you talk us through these various measures.
Yeah, and some things are commitments made during the election. There was changes around some welfare payments and making sure that the unemployed got the share of that. Since then, we have seen announcements around supporting farmers and farm communities and around aged care. Now, neither of those stories have finished.
No.
I wouldn't be surprised to see the government having to spend extra over and above these dollars.
And would you say the same about that final point, infrastructure, that there'd be more brought forward into the next 4 years as opposed to that 10-year timeline that they refer to in terms of the $100 billion timeline?
Yeah, potentially. So what is happening is Reserve Bank is jumping up and down and saying, well, they would like to see the economy moving faster and you get unemployment lower, you get wages moving faster, but the Reserve Bank can't do that just using interest rates. They're already so low. They need the feds, via the states typically, to be spending more on infrastructure. Now, at more than $4 billion in the next 4 years, that's great, but it's not terribly big bucks. It helps, but it's not a notable driver of the economy. It's partly why we see an economy a little less healthy than Treasury does short term and across those 4 years.
And Chris, finally, on the iron ore and commodities forecasts, is the government being very cautious on that in order to possibly surprise on the upside when we get to the budget in May?
Yeah, look, the hero of the budget in the last 18 months or so have been those commodity, the things like iron ore, coal, gold as well.
And this looks at how significant that is in terms of if there was an earlier fall to a lower price per tonne. It sounds wonky, but basically what it means is how many billions of dollars in terms of company tax the government will receive.
Yeah. And there's an effect there on the economy, there's an effect on the tax take. Basically, this has been the hero of the budget. Treasury is assuming that it goes from hero to zero in a matter of months. It's already happening. Iron ore prices are well off their peaks. Much more true still of coal prices. Iron ore is a great example, though, trading on spot markets over $90 a tonne. They see, Treasury sees its price, the 55 US a tonne by June. That rapid fall sucks money out of the economy. It's part of the reason why we saw on that earlier slide the big revenue rise.
And if it were to fall to $55 per tonne, it would be $7 billion the cost. If it's a later fall, and that's a windfall of upwards of $6 billion. So we're talking about big dollars in terms of the impact on the budget bottom line, and potentially, as I say, the government being conservative in terms of the projections, keeping that at $55 a tonne for iron ore, because they surprise on the upside, and that's a bigger surplus.
Yeah, and again, impact on the economy, impact on the tax take. I do think that iron ore prices will gradually fall from here, but they may not fall as fast as the government has factored in. That allows them to pull a bit of a rabbit out of the hat come budget time and perhaps do some more substantive things. Okay. In the meantime, though, bottom line, economy's weaker. Budget is still holding up. Yes, they've halved the surpluses, but as you note, maybe they're being a little conservative as they do that. that basic divergence between a weaker economy and a relatively strong budget still in place.
And just to wrap up then, you're comfortable with the way that they've wrapped up 2019 with this mid-year budget update and those projections?
They're being a bit cautious on the economy, especially iron ore and flowing through to the budget. They've hung on to a little bit of a surprise, potentially, come budget time. Apart from that, these numbers make sense.
Chris Richardson from Deloitte Access Economics, as always, thanks so much. Appreciate it.
Thanks, Kip.